Stop watching the Bitcoin price. Yes, it just broke $74,000. But that number is not the real story. It's the least interesting part of what's happening. This isn't a signal, it's a symptom. A symptom of a tectonic shift occurring in the hidden plumbing of the financial system. If you only see the price, you will be completely blindsided by what comes next. So why are the biggest players in finance all making the same move at the same time? We need to look underneath. Let's be clear, a surge to $74,000 is explosive. It forces everyone to pay attention. But focusing on the price is like staring at the tip of an iceberg. It tells you nothing about the mass and momentum underneath. The real story isn't the price. The real story is that this is the final confirmation that deep, structural changes are now locked in. To understand what's really happening, you have to follow the institutional money. Not the day traders, but the slow, deliberate, and monumental capital that just entered the market. This is a system-level reallocation. So what does this mean for how you should interpret this market? It means the game has changed, and the old rules for rallies and crashes may no longer apply. The real narrative is that traditional finance has finally built a bridge to Bitcoin. And now, trillions of dollars are starting to cross it. For years, the barrier for institutional money wasn't a lack of interest. It was a lack of infrastructure. A pension fund can't just open a crypto exchange account. They needed a regulated bridge. In January 2024, that bridge was built. Spot Bitcoin ETFs. But here's where the story gets strange. The moment that bridge opened, capital didn't just walk across. It flooded. Just look at the numbers from this month, March 2026. In a single week, US-listed spot Bitcoin ETFs absorbed over $767 million in net inflows. By the middle of the month, total net inflows for March surged past $1.3 billion. On a single day, March 10th, these funds pulled in over $250 million. Now, here's the part most people miss. This is not the same kind of money from past rallies. Retail FOMO creates weak hands capital, which leads to spectacular crashes. Institutional ETF flow is the opposite. This is strong hands capital. When a major fund makes a strategic allocation, it isn't trying to flip a quick profit. It's making a multi-year decision. This creates a powerful, persistent, and almost mechanical buying pressure that the market has never seen before. This isn't speculative froth. It's a structural bedrock of demand. As big as those ETF flows are, they are a form of passive allocation. But an even more powerful trend is emerging in parallel. This is where the story escalates from a rally into a revolution. This is active corporate adoption. This is where companies are converting their own treasury reserves, their cash, into Bitcoin as a primary balance sheet asset. And there is no better example than MicroStrategy. In a filing on March 16th, MicroStrategy announced it had just purchased another 22,337 Bitcoin for approximately $1.57 billion. That purchase was made in 1 week. With this move, MicroStrategy's total holdings have soared to a staggering 761,068 Bitcoin. Their average cost per coin is now about $75,696. Their position now represents over 3.6% of the entire fixed supply of Bitcoin that will ever exist. This is a paradigm shift. It sends a message to every CFO on the planet. Holding cash is a liability. MicroStrategy is showing the world that they believe Bitcoin is the solution. And every time another company follows this playbook, another massive chunk of Bitcoin is taken off the market and locked away for the long term. So, we have the ETF floodgates opening and a corporate treasury revolution starting. These are the mechanisms. But that begs the real question. Why now? Why is all this smart money rushing into Bitcoin at this exact moment? The answer is the global macroeconomic environment. We are in a pressure cooker that is forcing a historic reconsideration of what a safe haven asset truly is. For decades, the default was gold, but the data shows we are witnessing the beginning of what many are calling the Great Rotation. This isn't speculation. Over a recent 5-day period, while institutional spot Bitcoin ETFs took in approximately $750 million, gold ETFs saw roughly $400 million in outflows. That divergence suggests a seismic shift is underway, with investors increasingly viewing Bitcoin as a superior hedge against inflation and geopolitical instability. The macro environment isn't just a backdrop anymore. It is the primary driver forcing institutions to find a new, more reliable store of value for the 21st century. We've covered the explosion in demand, but that is only half of the equation. While demand is surging, Bitcoin supply is simultaneously experiencing the most aggressive squeeze in its history. First, the programmatic shock. The 2024 halving permanently cut the creation of new Bitcoin in half, to just 3.125 BTC per block. With only about 1 million BTC left to be mined, Bitcoin supply inflation is now verifiably harder than gold's. But the squeeze on new supply is being amplified by an even more dramatic reduction in available supply. On-chain data reveals a relentless trend. Coins are being pulled off of exchanges and moved into private cold storage at a historic rate. As of March 2026, the amount of Bitcoin held on exchanges has plummeted to just 5.74% of the total supply, a low not seen since late 2017. When you combine these two forces, a halving that chokes new supply, and exchange withdrawals that drain available supply, you create the conditions for a massive liquidity shock. A larger and larger wave of institutional demand is chasing a smaller and smaller pool of available Bitcoin. In this environment, even small increases in demand can cause violent, disproportionate moves in price. This isn't a bubble, it's just market mechanics. So let's connect the dots. Bitcoin hitting $74,000 isn't just a number. It's a fire alarm, signaling that the fundamental structure of the market has changed. We have now entered the age of institutionalization. Think about the forces at play, all at once. First, the accessibility engine. Spot ETFs have unlocked a multi-trillion-dollar ocean of institutional capital. Second, the corporate blueprint. Public companies are now actively converting fiat treasuries into Bitcoin, taking huge amounts of supply off the market. Third, the macro catalyst. A global flight to safety is forcing a rotation of capital out of traditional safe havens and into Bitcoin. And finally, all of this unprecedented demand is crashing into a programmatic supply shock caused by the halving and historic exchange withdrawals. When you see the whole system, the conclusion is inescapable. The push to $74,000 wasn't a fluke. It was the mechanical, almost inevitable outcome of these powerful forces colliding. It was the sound of the market repricing an asset for a completely new class of owner. If you want to stay ahead of these structural shifts and get analysis that goes beyond the headlines, make sure you subscribe to the channel with notifications on. So, if the daily price is noise, what are the real signals to watch? Forget the charts. Here are the 3 metrics that tell you if this new market structure is holding. First, ETF net flows. This is the bedrock of institutional demand. Watch the daily data from funds like BlackRock's IBIT and Fidelity's FBTC. A sustained period of large net outflows would be the #1 warning sign. Second, corporate treasury announcements. MicroStrategy created the playbook. Who is next? Pay close attention to SEC filings for the phrase Treasury Reserve Asset. Every new company that joins validates the thesis. Third, and most important, is supply on exchanges. Keep watching the net flow of Bitcoin to and from exchanges. As long as coins are moving into private storage, the supply squeeze is on. If that trend reverses, it could mean long-term holders are preparing to take profits. These 3 data points will tell you the real story long before the price does. So, the next time you see Bitcoin trading near $74,000, don't just see a price, see the signal. It's the signal that Wall Street has arrived, that corporate finance is being redefined, and that in a world of endless money printing, the demand for absolute scarcity is hitting a fever pitch. This isn't just about watching a number go up. It's about witnessing a methodical and monumental shift in the global financial order. This is one of those shifts that only makes sense once you see the entire system at play. The battle for $74,000 wasn't the peak of a rally. It was the sound of a new foundation for the market being laid, brick by institutional brick. The game has changed, and for those who see it, the opportunities have never been greater. Thanks for watching.